Hello, afternoon. You don't seem to have a username, but afternoon. Hopefully the volume's all working properly today. Hi, VDK. Brilliant. So are you all, I'm getting the sense from a lot of people I'm speaking to today that they're not really doing a lot, and quite rightly, probably everything's back end loaded this week, isn't it? And it's summer, volumes are rubbish. There's no real new news since last week. Chat through a few things that have been mentioned, but let's wait for a few more people. Still haven't got my preview back from the editors, so it's late again, but I'll have it out to you as soon as I can. So we can go through that on screen. Some useful charts. I think it's just that I've come across. It's just worth having at the back of your mind for the next couple of weeks. It has been pretty volatile, hasn't it? Has everyone managed to come through it unscathed, or did you lose any accounts? Right, so it's 1 o'clock. We'll get going. Brilliant. Nice to have you on board. Please ask questions. Don't be shy. Nothing is too simple, and hopefully nothing too complicated, even for my small brain. Things I'd like to just go over today. It's politics, not data this week. It's very quiet, earnings and data-wise. There was something possibly pivotal for weeks ahead with Germany producing a federal budget. Now, they're a classic case in Europe of having a kind of conglomerate politics where you got more than one party together. There's no outright winner, so you have to have negotiated outcomes, and this is one of the problems. It's the people that are involved. The Greens normally seem to be and it's the same in France, in the middle. So they're very much against too much spending on military side of things. So they've decided that they can't afford to spend on Ukraine, but they'll stick to the building out of the German military again, which might cause a few issues. And such results are going to obviously give the Green Party in France a little bit of ammunition as they continue to go through these fantasy budgets. Now, is that actually going to have any issue in the Ukraine and the Russian outcome? Will it force America to ignore what Trump said before, that NATO has to pony up and put money in? If they're doing it at home for the NATO budget, they can possibly get away with not doing the extra direct investment in Ukraine, but it's going to cause some issues. And if Trump gets back in the lead or stretches his lead in the electorate college part of the vote, which is going to decide it, he might start making noises again about ending the war in Ukraine, particularly if no one else has put the money. Germany was second. So that might be another reason why when we go into seasonal selling in September, there's just a little bit more geopolitics coming out of that whole issue. So keep an eye on that. And then that also ties in with politics this week. We've got the DNC, the Democratic National Conference for the Democratic Party. They make their official nomination. We know it's Harris, obviously, but it gets T's crossed and I's dotted. That gets over the line, but she's going to be pressured for some quite controversial policies, some things on price controls which haven't existed in the States since the 80s when Reagan got rid of it, mainly because it's a non-market outcome. It's never very good, and it's quite easy from a freedom of politics and freedom of markets angle to shout down. So she'll be attacked on that by the Republicans. We'll see what else comes out of it, and maybe they'll get pressured on issues like the Ukraine. So there might be some market moves on politics this week, which isn't overly helpful either. It tends to be quite reactive. I don't think it's going to move the dial on a lot of the big players, which have come back to the market because what we were saying on Friday, it's all about the volatility function, which we'll run over again for anyone that wasn't there when we go through some of the charts soon. Obviously, geopolitics in the mix helps with gold, but I'll just reiterate again, there was 3,300 buy contracts in physical denomination on Friday, just on the CME. That is basically 10 tons, and we'll go through how relevant that is relative to gold that is mined on a yearly basis. This whole change in thing, if you've got nobody particularly wanting to sell it to you, you're buying more than what some small countries are making. It's something like 50 tons, or 70 tons have been traded in physical format for the month of August. That starts to have an effect, which is why we're trading at all-time highs, etc. But again, if you've been following what I've been talking about, this is a wave 3, a minor 3 that we still didn't think would finish until it at least got to 2,500. There is a valid short-term top, but I still think within that, there's one more wave to get us to that top, of which I'll show you why I think that 2580, 2600 should still be the stopping point for me, but that doesn't mean we don't have 1 to 2% pullbacks. We're trying to have a pullback already today. 2450, maybe 2430 is a potential launch pad, but it doesn't have to like that much. Look at that one. Dollar wise, we talked on Friday. It had done enough to be valid for 5 waves, even though the pattern suggested there might be one more low. It was quite complicated. We have put in a lower low overnight today, so that makes that valid. We're all still expecting, as we did last week, to beat some bounce in the dollar. That might be just a little bit of nervousness over what is going to be said at Jackson Hole. So we've got obviously got DNC until Thursday. Starting on Thursday is Jackson Hole Symposium, where a lot of the major bankers and economists, but mainly the Fed, speak. Powell speaks on Friday as a main speech. The ECB's economist Lane is speaking on Saturday. But there are 3 days of it: Thursday, Friday, Saturday. So look out for headlines even when you get into next weekend. I'm only around until tomorrow night. Then I'm away for 2 weeks. Probably won't receive anything much from me. If it's really urgent, send it through, and I might be able to pick it up and give you any help if you need it. And then the other thing is are we likely to? The dollar obviously caught a bid when the Trump trade was put on, and that has been sort of unwinding. But as I said, if there's any fallout from DNC that is negative, that again should see a short-term bounce in the dollar. So look out for that. UJ itself, we've been talking about a bounce back to the 150 level. We've sort of touched that. All of it looks very 3-wavy, so it does look like connector-ish. So it could go higher, but we're now pulling back in a 3-wave format. So the original idea is that eventually, if the negative path returns and the interest rate cycle continues, and the data still keeps coming in strong in Japan, then we could get back to sort of 130, 128. If you start seeing big interest rate cuts in the States, if they do end up being behind the curve, then we're talking about potential 100 is the pre-COVID equalised back to sub 3% interest rate. So always keep in your mind. We kept going on and on about where the gold movement would go to, and it's got there. There are some of these things that just take to play out, but it should be the overriding trend. The other fallout from that federal budget in Germany is obviously, are they pushing for monetary policy help here? Are they saying they've reached their limits of fiscal help and trying to send signals to ECB to start cutting rates regardless what states does? So it may well start putting a little bit of weakness into EU. Just keep an eye on how this all develops. At the moment, to me, it feels like they're all set up to be waiting for whatever the Fed does in September, and then the major banks will definitely follow them, etc. Anonymous, if you tell me your name, we'll talk more about gold. You can't come on and call yourself anonymous. Dreadful behaviour. Go on. But anyway, what's your question on gold? Or are you saying you like what I've said about gold? Remember, the key thing on gold is that the people who do most of the selling and carry the short, so like JP Morgan, Bank of America, working on behalf of Anonymous has just received his 5th payout from Alpha. Fantastic. Make sure you go on to Trustpilot, etc., onto Twitter, especially Twitter. Just answer back some of this hate mail from the people who've been cheating. It's just ridiculous. If you behave, Alex put out a fantastic update of just how much money we pay out. Of all the data that everybody provides, we're in 2nd place on that, with some very serious amounts of money. It's a real shame 90% of people that actually behave don't feel the necessity to be all over Twitter in a positive light. It's sort of like it's become a parody of Musk himself, hasn't it? It's just ridiculous. All he's managed to do is get back the I love myself brigade. Hello, Uncle Planty from Andre Gallo. Hello. That to me looks like my Romanian friend, Mr. Veshinu. He's been doing very well. He's on the payouts. Come back from. If anybody wants to go onto my chat and search back a few weeks, this is a guy that was struggling psychologically with the way he was going through it, and he sorted himself completely out and turned it around just by back-to-back talking to people on my chat who were very, very helpful with him, talked him through it, got his confidence back. And look what's happened. Brilliant. 20K payout. Absolutely wonderful. Well done, mate. And obviously, I will be in Romania at some point because we've got to visit you guys. You're brilliant. Absolutely brilliant out there. So where were we? Yes, UJ, the other big political issue or central bank issue, Ueda has been requested to make his presence at the upper and lower chambers of Parliament on Friday to basically explain what the hell's been going on with the monetary policy. I think he should be fine as long as it does not retrace any of positive commentary and actions that they did at the last meeting. They were spot on. They didn't expect the US data to fall through the floor, or maybe they did because they didn't want to have to do all the heavy lifting. The real disaster from the carry trade was really the panic from the US side of things. But those rates might have had to be 50 basis points, multiple 50 basis points. This whole idea of going back to 100, we talked about it the other week. If you suddenly lose 33% on the carry trade, and you just, as a result, say you're invested in the Nikkei 225, that lost 30% in 17 days. As that dropped 10, 15%, blah, blah, blah. You were losing on both sides of the equation. And that was panic on, risk off, panic on, get me out of here, whatever the cost. And that very much happened. And what we're going to talk about with the few charts in a minute is those vol players will play even if they've had to lock in losses getting in and out. And you've got to remember a lot of this is averaging and getting out from a much lower level. They play long term. So probably still made money. They just gave up the last 10, 20%. They are very happy to get back in, even if it's at high levels and they've just sold at, if the vol levels are low. So this is why sometimes the markets look really confusing. It's like, how on earth can they be driving it up 10% when it was down 2%, blah, blah. They're not bothered. They're bothered about the relative movement. Even though we've moved 7 days in a row with the S&P, that vol rate has come down from the outlier 60, settling in the 30s, back to 14, whatever, on Friday. Now, if you're sub 16, something I've explained before, on the volatility, that's annualized volatility. You divide it by the square root of 256, is effectively 250 trading days a year. So your daily volatility is the VIX divided by 16. So that is now back below 1% per day in either direction, implied. And these big quant funds put their money to work when it's a benign environment like that. And they'll keep doing it while ever it's behaving in low vol terms. So be careful of fighting some of this upside. And the other thing is, and it's in the pack this week, the share buybacks. Remember we were talking before Q2 earnings that they're at record highs. Harinder, not a problem at all. Very happy to help. The share buybacks are running at records. They get turned off while the companies report and come back in a sort of sequential order as they've reported and gone through their closed out period. So it's a rolling thing, but by I think 2 or 3 days after the 5th of August, something like 80-90% of the buybacks were back on track coming in. So you've got an underlying support there. The buyers, the guys that have been closing out want to still be involved because it's low vol, and the market themselves, companies themselves buying their own stock. So funny enough, everything steadies up, etc., etc. Has this come through? So we'll have a look. The indices, to me, it's a great run. We've gone past the 50% consolidation we talked about. We'll through that on Friday. Some of them are sat above 61.8 and close to 5-wave moves. So that suggests that even if we're going to have a consolidation now, which we should do, and even if it's going to turn down again, there should be another 5 waves up to at least challenge the all-time high, if not come short of it. I don't think. So what I think it means is if we do go into further downside, we're more or less doing a flat pattern, which might have a lower low, slight lower low than what we had on August the 5th. But this would be worst case scenario. I think the A case, the primary case at the moment, is that we are in an impulsive move up, and we're just going to go through some consolidations. Ultimately, I think there is a top of significance coming in the middle of September, which is what we said with the 3, 4, 5 upside. We've got the 4th wave. It was a bit bigger than we thought it would be, but it still sits with the pattern at a higher degree. And to me, I wouldn't fall out of love with the market yet, and it's at worst sort of halfway to where it's going to end up. We need to see. I'd love to see a little bit of consolidation over this quiet week into the Jackson Hole, and then hopefully we resume going forward. But to me, it all rests on what markets sentiment is going to be like going into NVIDIA next week on the 28th. That is what after hours week on Wednesday. So ideally, we are going sideways to flat into that, and then we rally to a high afterwards. But you can't really predict that. Anonymous, I'm not on a chart at the moment, so I'm just generally talking. So there's a couple of. I'll go through some charts. I've got some other charts that are in the weekly preview and outside that, which are useful information of trends, fundamental trends that are going on, which will affect general interest rates and the dollar and tech investment in general. Big thing is that hedges are now overweighting into tech. The VIX is back into safe zone. So, like I say, just because we sold off in August for carry trade unwind, I think people need to try and put that to the back of their mind. The fundamentals in the line. Remember, I've been talking a lot about AI bottom up, of why that is a secular trend that will continue. We're only at the start of it. Ignore the market's little sulk about the big boys and its capex. Look at all the people that are reporting below. I talked on Friday about JD.com and Alibaba, the people that help underneath, and reject those two online retailers making big efficiency gains using AI. Walmart, who beat because they've got rich people trading down, have just changed their catalogue with, I think they said it's 185,000 items, which they've had to double their workforce to do manually. They'll get an AI process engine going to do all the work. These are sort of things that are happening at large, bottom up, efficiency gains, which make more and more people get hold of them. And there's another chart that's in the thing. 94% in a survey of Excel spreadsheet users, financial spreadsheet users, found at least one error that was material to the model that was kind of unknown. And I don't know if you've ever done macros and stuff in Excel, but you tend to get all sorts of recurring errors and countback errors. So some of these AI people are going through just on basic data to clean it up, to make it better to be used and be reliable and create efficiency. This is just absolute huge opportunity that will drive the next breakout leg, whether that's 25, 26 in AI, which it probably will be, because I think, as I say, the Palantir CEO, co-founder, the other week said that whole addressable market is 30 to 40 trillion, which they think they'll make 30 to 40% gains on by 2027. That's a huge amount of opportunity. Right. What do you want to look at? So have you all been checking every day what the previous day's physical deliveries have been on CME? That should be almost your first stop every day if you're trading gold, just to completely confirm for you what the buying trend has looked like. So that's the page again there. It's the delivery page when you go into CME. And futures deliverable stopped out to date. Look, we had 3,298 on Friday. Right? What does that mean? That means they've got to be delivered by Tuesday. 3,298. Multiply that. That's by 100 ounces, because those bars are 100 ounce. So then you've got 329,800 ounces of gold. Divide that by 32,000. That's the amount of ounces in a ton, and you've got over 10 tons of demand on one day in the S4. Now we know there's been 21,000 for the month, so 70 tons of gold for the month. We looked previously at the year to date. Look at those yearly totals. There's only June when we had the breakout of 30,000. What date are we on in August? We're on the 19th. So we're still on track to be possibly the biggest month. And we're just about to go into the seasonally strong period. We're not even there yet. You can imagine what the demand for physical is going to look like in that period, particularly if the BRICS unit comes. So don't give up on the gold upside, mainly because the fundamental buyers are still here. What I was about to say earlier, before I interrupted myself, Bank of America, JP Morgan, they tend to run the big shorts, often for the Fed, who are trying to just make the dollar look big by selling gold. And on the non-deliverable basis, they know how much demand is around the physical side of it. If they could find a level where they can squeeze it to and find sellers, they'd do it. But at the moment, it's very, very expensive, so they're having to chase physical settlement. They themselves are anywhere between 2,500 and 3,000 for the end of the year. So we're fairly underpinned. I think the pullbacks, you might be able to get something, we'll look at that in a minute, seemingly low 2,400s and below. If you get a very quiet period, or you get an excuse to use a strong dollar day, you might be able to get some synthetic selling, some paper settlement. But as we keep seeing, the more it gets hit down, the more physical buyers are turning up and asking for delivery. It's very, very difficult. It's impossible to trade through those, because if you're going to trade with a guy who wants to trade physical, then you have to have the amount of money pledged in the account until you deliver the gold bar, just to make sure that you settle. And very few people want to actually do that unless they are going to settle in physical. So that's the background to that. So what does the chart look like? So what are you guys thinking? So we've got Anonymous, Reshanu, Dave. What's your ideas on the gold setup at the moment? Obviously, we've put in the next all-time high on Friday into that delivery frenzy. We were saying last Monday that we thought it was prepping for a breakout here, or was it going to do a double correction? But we said we didn't think we could get through that 24 barrier, even if it did sell off. And then we've run into all this upside. My central case was that we were going to have 5 waves which meant we'd have to have an all-time high. To me, we've had 5 subwaves that's put in a minuet, sub-minuet wave in my parlance. These small case reds. The larger case red 3, there's a -3, that is 4 degrees higher, which is what we're working towards. I think there's a 4 and a 5, which will complete the whole process, which should come out. If you remember, the channel that I've had for this 5th blue wave for a number of weeks now, suggesting up here 2560. From what is now 2 or 3 months, we've had a 2-spot 618 target on the wave 3 itself, just short of 2550. That's this horizontal channel that we've been trading in for the 4 degrees higher. Now, often when you come out of these channels, you get an overthrow. First case scenario for 5 waves, particularly as this middle one, the 3rd wave extended, is that wave 1 equals wave 5. So I'm estimating potential pullback to 2450 on this, which is a 38 fib. That's the first instance for wave 4, and then basically 120 points, just like the wave 1 was, up to 2580-ish. Hello, M10 Productions. I'm very well, thank you. So Anonymous, you think it will touch 2510? I mean, that is a valid 5-wave finish. Absolutely. So that would be a new all-time high, wouldn't it? Finish at 2508, wasn't it, on Friday? 9. The weekend was very good. Yeah, lovely weather. Lots done. A lot of prep for holiday. Lost at cricket again. That was rubbish. But, outside that, no, everything was good. Yeah, I say an ultimate high by definition could be an end to the 5 waves. I'm just saying this looks like a quite nice confluence to finish the whole move off. Normally, you get a blowout for a wave 3 of significance. I like to think we come out of that channel 2580, 2600 touch maybe, and then we come off. At the moment, as I said earlier, I think it could easily be a shallow pullback because we are in a very impulsive mode and there's deliveries all around. But someone's tried to sell that quite aggressively today, so that's kind of making me think that there isn't a lot of delivery popping its head up at the moment. M10, right? Okay, I mentioned this a few minutes ago. It's very rare to find any positivity on Twitter, as you know. Alex kind of addressed that. 90-odd% of people are being paid out. Alex has showed you the numbers on Twitter itself as a reply to a lot of, as you quite rightly describe as FUD, which was sitting in 2nd place last time I looked, which quite a high number. It'd be really helpful, as I was saying, all these people that are actually receiving money, you should take these guys on and tell them. Because it's a load of nonsense. If you haven't been doing yourself, even if you haven't cheated and you've been very unlucky to get caught up in the mechanics of it, if you're doing things that could fall foul of looking like you're doing concert trading, etc., then you're going to struggle. Just try and find a way of trading cleanly. But I'm not involved in all that. You'd have to go and speak to Alex and the mobs to find out exactly what's the problem when you've been denied. But it's a very small percentage of people. The majority of people are making good money, and we're paying out ever such a lot. Right. As far as you know, China doesn't buy gold for 3 months. Right. Again, I put on my chat last week, I think it was, a very good article by someone who's been watching. There's a 400 ounce bar that the UK LBMA deals in that has been turning up in the import numbers into China, which has been sort of disappearing in the numbers, hasn't been claimed yet. Their official reserve data hasn't been moving, but they're fed up with people looking at that and going, oh, look, China are buying, then let's dive in. So they try to obscure it a little bit. And the net imports into China are massive from the consumer level and a lot of the other non-asset reserve facing agency parts of the Bank of China, which is a bit of a mouthful, but that's all the other. It's like it could be anything. It could be the housing side looking to back out their bond exposure into gold, etc. But loads and loads of gold. There's supposed to be 32,000 tons plus. They've only got 2,000 declared officially, 2,400 what it is for the asset reserve account. But they are still buying gold. Banzai. Somebody has been buying 3,000. They said 21,000. 21,000, 100,000, sorry, 21,000 100-ounce bars, which I said earlier, that equates to 70 tons of gold. Just while we're here, let's just go to chart. I was going to show you later. It's a very good thing. Right, hopefully you can zoom in on that. That is gold production by country. That's the actual amount produced. So 70 tons in 19 days. Right? When people aren't necessarily selling it, you're struggling to find it. We've talked about why the market is structurally short. And 70 tons is more than Brazil produces in a whole year. Kazakhstan produces nearly twice as much as that, etc., etc. So you can look through. This is a tremendous amount of gold to find in a market that, until January the 1st, 2023, had no reason for anyone to settle in gold. Now you've got people actually asking for it. So the historical 4% of gold that would normally physically settle is being pushed up. All this paper trading that goes on and people trying to smash through physical buyers who at the end of the day weren't that bothered. There's now a reason why people want to own it. We've talked about it loads. Settlement issue. To have that account you're talking about for the Chinese asset reserves ratio, where gold is the only asset other than the dollar that can be reserve assets, you have to have 85% of it. We've got the unit coming soon, the BRICS currency, which is going to have something like 30 to 40% needed in gold to be able to pledge against it. So gold is going one way at the end of the day. 3,000 by the end of the year is a reasonable projection. So we're running out of time for it to come off. You should be looking, anytime you get a very obvious three-wave large-scale move, you should be buying gold. So is US gold production import? So the problem you've got there is China, 370. They, even if it's a company, they tell them what to do. In a survey of what consumers, retail holders in China would do, 95% of them pledged to pledge it to the government if they were asked to do so. In the US, there's not a single person that would pledge that gold to the Fed, and neither do they have any scope, or the government have much scope without really bringing in an onerous law that would create havoc of forcing any public limited company to offer their gold to the US. Right? So massive issue. The other problem that the US have got is lots of people in the market know that they've been loaning out a lot of their 8,000 tons. In fact, remember I told you in 2014, when Germany asked them for their gold back, they couldn't find it. They told them which vault it should be in, but then couldn't find it, and sold them a higher quantity of lower quality gold just to send it over. That's the kind of problems you've got with the US. The Fed has spent so many years messing around and pledging stuff left, right, and centre that there's no guarantee that they've got all of theirs. But China have probably got access to 32,000 tons. You know, to look at those charts of who owns how much gold. India are buying massively too. This all makes sense when they want to change their currency. So the physical demand, and people have got to get their heads around this because it is affecting how a lot of the charts look, because when it looks like that they should sell off massively, it's not taking account of the fact that what sometimes is an order block or levels where there's been support previously is literally a different animal. It's not someone filling in a paper short and walking away. This is someone that's saying, I'm not moving until you find that gold bar and sell it to me, and you're on the hook. It's completely different. So again, I said we've put in a 5-wave move for the wave 3. Siraj, who's asking why is gold going down today. So it's highly likely that we had that big amount of buying into Friday. Took it. If you remember how much it played around at 2,500 before it broke through, finished late at high level. I would imagine that 2,500 is a level where there are some gold holders that were willing to sell. We've been waiting for that. It's a round number. It's a classic. Today, there isn't probably a massive order for physical gold settlement. So that is a time that you take it on. Plus, what is the dollar doing today? It's had follow through. It's put in that lower low, and now we're having a little bounce. Now, the dollar, when we look at it in a minute, I think that is almost at a valid level, ready for a bounce. But what it's really telling you is the old read-throughs, the dollar, the geopolitics, are only really working at margin. This is dominated by physical. Real rates this week, if you're going to line it up with interest rates, if anything, the commentary is going to go down to, right, the Fed hopefully is going to be cutting rates and signaling that at Jackson Hole, but it's going to be 25 basis points. There's no data between now and then for them to change their rhetoric. They sent Goolsby out to bat on Friday, who is the super dove, as we know. He's been trying to talk it down. He doesn't want it to be a guarantee. There's no guarantee that we're cutting, and don't expect there to be. So expect there to be some sort of what the Fed is. The market's still priced in 93 basis points by the year end, and 200 by the end of next year. The signalling from Jackson Hole this week is going to be 25 bits at best for 3 months going forward. Now, when we go through it in a minute, Charles Evans, the former Chicago Fed guy, he said, look, the problem is once the trend in unemployment starts going up, it's not something that flashes around. It doesn't turn quickly. In fact, it normally accelerates, which is the whole reason why people are expecting the data going forward may suddenly get a lot worse very quickly. Might not necessarily be this month. We might have a sideways, we'll have a small jump at the start of September, which again will be taken hawkishly. They've got to get through that. They've got to get through another CPI and a PPR and a PCE. So there's lots of data points, as Goolsby was saying, before they even make that decision. We've had a good positive in the fact that Bostic has rolled over. So Bostic is the Atlanta Fed governor, and those guys do the GDP. So all the data that comes through, we watch it real time. That's been rolling over back down to 2% now for Q3. But they do another important one, which is sticky inflation, 3 month on 3 month, which is a very good way of smoothing data into a proper meaningful trend, and that is right below 3%. So after that piece of data came, Bostic overnight went to the FT on Thursday and said that he's of a mind that both sides of the equation, growth and inflation, are moving to somewhere that we could see a cut in Q4. Well, we've only in the September quarter, we've only got September left to do that. So that was not rocket science to work out what he was saying. So it's very unlikely that they're not going to do the 25, but what they're trying to negotiate now is, right, we're definitely not doing 50 and we're not going intra-meetings. So everything's calmed down. And that's a feedback loop into making the volatility disappear from the market, which is bringing in the large quantity, et cetera, et cetera. So M10 Productions, right. Hello, Mookie. Nice to see you. M10 Productions. Sky seems the limit for gold with all the geopolitical recession stuff. Yeah, but the recession thing, Goldman's are pushing back on that today, 25 to 20% chance now, maybe even 15 if jobs doesn't deteriorate quickly. So they're all jumping all over each other to, first of all, ask for intra-meeting cuts to now trying to get back in the pack. The recession thing, the problem they've got, and I talked about the other week, is nominal GDP, which is volumes times price. If the volumes are slowing down because price is too high, prices will fall. Will it be quick enough to make people still buy goods to keep the GDP going? And then as the inflation number is falling off, the real GDP, will the inflation fall quick enough to offset the fall in the nominal? Again, a load of gobbledygook, but as long as the US overall is growing, then they'll be fine. The issue they've got is when the nominal growth of GDP drops below the Fed's funds rate. At the moment, they're bang in line, but all the commentary we got out of ISM manufacturing and a lot of the commentary from the companies through Q2 that have said it's all been about prices and that the consumers stop paying. Everyone's trying to trade down. So it's telling you that the price element is going down. So unless we get a massive pickup very quickly of discount buying by the public at large, and that's those that aren't seeing their mortgages roll over to higher rates, there's a massive incentive to get rates down quickly. So it's all a game of chase the ace. But that recession thing at the moment, isn't necessarily coming through. We've had record S&P move up over Q2. We've said there's 10% have said that they had a small downgrade to Q3s, not that they were going negative, just that they weren't anticipating growth as quick as before. But that's mainly in the larger economy side, not in the tech growth side, really. The only tech downside has been in sort of Internet of Things and the auto side. So we'll see whether they can have a bounce back. But again, that will generally be on the consumer goods side of things picking up. So it all becomes self-fulfilling. Can you get prices down enough to get the upside quantity going? Well, you can't. You're not going to do that if you keep talking about I need to see one more data point and data dependent. Blah, blah, blah. Exactly what are you data dependent on? Because even the girl that made the SARM rule, she said there's only been 9 occasions to measure that. That's not enough data points to say that it's a rule. And she can't define what data she'd need to see a rule to be valid. So what the hell are the Fed expecting to see? It's just absolute nonsense. They need to get on with it now. Gold long term, then 3,000. Anything could happen. I reckon there is a huge chance at some point in the next 2 or 3 years the whole thing goes back to a metal standard. Whether that incorporates some kind of crypto is another issue, but I'm not so sure it will. I think the other key thing about what the BRICS are doing is it's BIS, the Bank of International Settlements. They're the ones that have implemented Basel III. They cut their gold short. They had a long-term gold short position. They cut that in December 22 before January 23. You suddenly had to own 85% to be able to settle as a reserve currency. So the insiders know what they're doing. They've given the BRICS access to their Mbridge blockchain technology for digital currency settlement. So it doesn't necessarily have to be a crypto, but it can be a digital settlement. They're probably going to use that. And then the issue going forward is the 85% that you've got pledged with the BIS, etc., under their rules, can you use the same gold to pledge against BRICS unit, or do you have to have even more, which would be super bullish? But either way, you're going to have somewhere between 40 and 85% of physical demand to match against currencies or reserve status. That we're only at the early stages of that. I reckon we're about a quarter to a third of the way through that demand. So, where exactly does the big pullback come from? Potentially, it's a positive story for the markets going forward that they get inflation comes down, the deflation coming from China just helps completely on the supply side. We just keep chugging along. Soft landing isn't necessarily the best situation for gold. We talked again before. We want the Fed to sort of get it wrong and to be cutting in a large way, get the real interest rates down quickly, take away the opportunity cost of owning something other than gold. That is the key. So if you get a soft landing, that might be a time. So when we get this fifth wave on the gold chart, so we're up here and we put in what will probably be our first point of call is a 38 spot 2 pullback. That is when we can potentially get into the 2200s, 2300 kind of area for a pullback. That might be on the fact that the markets are flying at the start of next year. Rate cuts coming slowly, but remember what I always say: growth trumps everything. Our little racehorse, he will win in most scenarios. It'll be the reason why. That's the reason why, even though the market was talking about 50 basis point cuts, intra-meeting emergency behind the curve, markets also got slammed, not just on the carry unwind, but growth disappearing. There's a growth panic, and that always trumps. Because if you believe that the growth is going to muddle through, then you will buy the dip. So yeah, gold long term, I think the 2,500 to 3,000 is a probable finish for the year. What happens when we have seasonal unwind in September for indices, and will all depend on probably what the dollar does. Is that going to be a risk off moment, or is there a reason for the dollar to be panicking down? That might hold gold up. But in general, that's probably one of those moments when you've got a little bit of positive correlation between all assets, a little bit of total risk off into the pre-election rally, and then all things change. But in the midst of that, what's a curveball this time again is there's the October conference for BRICS and rumoured potential starting of that unit currency before their conference even. If that happens in September, then that would marry it with a small panic for the dollar. You don't necessarily get people buying the dollar if they think it's the end of the dollar. So we'll just have to see how that plays out. That could be a very, very volatile period, but that may be when we get our first chance of a decent pullback to buy again, and then I think we shoot up to 3,000. So everyone okay with that on gold? So I would be looking for 24.50. Someone else was looking for down here, I think. Yeah, 24.31, 32, which was the previous wave 4 low. Often you get wave 4s lining up as support spots before you rally again. That would kind of make sense in the short term. And we've found increasingly the sell-offs have kept running into physical orders that haven't really moved. So I would pretty much suggest, given that there's 3 big rally points there all in a row around 24.30, that looks like a zone that will hold. I'm looking for the 24.50 entry probably. If we can get an intraday one lower than that, all well and good. I do think we've got one more high to go to finish this, what's basically been a 4-month move for wave 3. So everyone happy with gold? Any other comments on gold? Boom, boom, boom. A preview or not? You're happy, or you've got a question? My preview has arrived, so I'll try and download that and post it, and then we'll go through it. It's not playing ball at the minute. Not quite sure. I think it's probably because I've got too much open. Well, I'll just go through it from the anonymous. No problem. Right. So what you'll see in this week's preview, I just basically talked about what we said a minute ago, 25 basis points looks like the movement through. We've got Jackson Hole and DNC. We've also got Ueda on Friday now having to explain himself. So the back end of the week is when it might be worth being around for a little bit of volatility, but until then, it looks fairly dull. But as always in the summer, allow for bigger volatility and pick off limits with lower staking, just because you're generally going to have bigger moves. But remember, the VIX has now dropped back down to sub 16, so sort of implying X news, it's not going to be that volatile. So last week we got PPI with a negative, so there's no pressure input-wise up on inflation. Real rates are tight. As Paul Donovan, who used to be the economist at UBS, or still is when I was there, he was saying, still talking about used cars, which no one is buying, and the made-up rents, the OER, which nobody actually pays, and they're the two main components, which at the moment are keeping inflation absolutely high, even though it's disinflating. So we're being dictated to by two things that don't really exist. It's a nonsense. Everything else below that is kind of falling back. So CPI, that actually missed at the headline, 2.9. Core came in line. But again, was it 60% of CPI basically is down to the shelter side of things, the rent and made up rent. And that jumped up to 0.4 from 0.2. We thought it was on a downtrend the previous month. So someone said that made of the 16.5 bips that basis points that inflation went up last month, 23.5 of them was due to shelter. So if that's the case, it tells you everything else is going down. So should you be panicking? Should you not be cutting rates at the time? I told you, we talked about Boston doing a U-turn, etc., etc. Shelter is weird. It's way behind. They do this rolling 2 months, 2 lots of 6-month data from different surveys to try and work out. The problem is it's so slow in moving. The estimate off the price of a house. Now they can be seeing falling house price inflation, but still be high. It takes ages for the real slowdown in rents to come through. So it's a little bit crazy, particularly if you've got people who are paying mortgages. Their unwind rate to go on to the next, to roll over to the next one is 34% higher payment on average at the moment. So those rates need to come down. The banks that were all told to buy more bonds, government bonds last year in the crisis for the Silicon Valley Bank, are all massively underwater on those. They need interest rates to be coming off for a bond rally just to get them out of those mark-to-market losses. There's lots of people screaming. There's lots of delinquencies coming through, etc., etc. So, normally when you see those kind of signalling, you steam in like the Royal Bank of New Zealand. 2 months ago, they were saying, we might need to put rates up. Last month, they said, actually, things are slowing right now, we're getting a bit worried. So this month, Jeepers services are slowing, 25 basis points cut. We're going to do another 2 by the end of the year. And we want to get it down to 3% by mid-27 at the latest. That is proper central banking. That is messaging, changing your mind. You've had Bostic until last week saying, we can't cut them because we might have to put them back up. So sorry, you're supposed to react to the data. Grow up. So market itself, S&P had a 7-day streak last week, longest since December 23, and it was the longest since 22 when it was 6 days on the Thursday. Mentioned Sam and her not convinced about her own data. Remember, this week, FOMC minutes on Wednesday, completely ignore anything and buy or sell whatever the reaction is. Remember, that came, that came before the ISM manufacturing miss, and the non-farm payroll shock, and the market meltdown. So any comments from that set of minutes is totally irrelevant. And you've got Jackson Hole the next day, which is relevant. So please don't give me any of this nonsense like we had, a couple of months ago when you had cash and carries comments that they might have to hike again. Even when people read that properly and he backtracked himself, was only mentioning it as an aside just to get in the minutes. Don't take this thing too literally, and it's out of date. So here, this was quite important. Charles Evans, former Fed Chicago, said they should be in an okay place. Same with this stiff performance bar since January of being data dependent, etc., etc. But now he says it's time to talk about what they're going to do and actually do it, which is how they should be. Because he said, from his experience of being Fed official, once unemployment rate (UR) starts going up, it's hard to rein it in quickly. You are behind the curve by definition, and people will cut jobs before any rate cuts will change their mind. But they're making strategy decisions now that a rate cut in 3 months probably won't affect. And then it's such a lagged effect, it might take 2 years to come through, which is why you should be massaging it down. They should have started by now. So when you get PMI manufacturing slow, you got the unemployment rate going down, then when they're going the wrong way together, you normally have normally a positive correlation, and it normally leads to a serious slowdown in the economy. Not necessarily a recession, but they need to start thinking that things could roll over. That is their job from the data that they look at. Don't understand why they haven't. And this is some work done by a chap called Michel Alouette, a French guy in a French group, CIS group, who do some useful charts each week. Had this one in. The blue line is as relative to what happens to unemployment rates if we've just gone past the SARM rule, etc. So if that is going to follow history, it suggests that there is more upside pain to come on the unemployment rate before it reverses. So good chart, keep that in mind. The other thing, Farmageddon, we're getting more and more commentary coming out about the whole Mpox thing. Not quite convinced that it is of pandemic status, but it does seem to have a high death rate at 0.3 to 0.6%, isn't it? 20 times higher than it used to be, so it is mutating. But is it a serious issue, or is it just big pharma trying to have an excuse to force us into lots more drugs? Discuss. We still haven't decided whether COVID was the right thing to do, have we? You get shut down if you even try and talk about it. The other thing that was blamed a lot over COVID was juniors on the desk. That is true, but these juniors, I think it's an excuse to make more money for pharma and WJ. Totally agree. But just be careful that it doesn't come into the narrative in the next few weeks. There's a reason to set it off. You know, if to me that is just another. If that gets us down for a double dip, that is definitely something to buy. I don't think this is going to mutate in any meaningful way that is going to affect things. Yeah, so there are juniors on the desk, but a lot of these are often quite experienced guys. But what happens is the guys running operations will be on a month break, blah blah blah. They'll be in the Mediterranean somewhere, and they won't want to take calls. So it'll be all right, make the prices wide, make the bid offer volume as low as you can to make it really, really thin markets. So this is why things tend to go the wrong way. And what happens is people who need to get something done often do program trades, so they get everything priced on block, and then the investment bankers have to unwind it. And that often causes a lot of volatility in the index levels because they can't. There's no volume to get out of the underlying. So you have to hedge it at the global level, as it were, and that's where you start seeing the volatility come back from. So that is true, and that does happen, and that won't really change until September. And of late, because of this September trend from the middle of September being quite weak, people haven't tended to really change the liquidity that much until October for the last few years. So be careful. We've got 6 weeks here that could be quite volatile at the margin, but that might just be over a number of days rather than necessarily volatile in the actual day itself. So hence what I said a minute ago, take your staking down for the next 6 weeks just to allow for a little bit longer volatility. Within the technical analysis arena, people that I look at bulls and bears alike, the bearish lot have been calling for the end of the world for the last 18, they've called 20 of the last 3 downturns. We're obviously jumping up and down. They've nailed it, completely nailed it as of August the 5th. And now they're starting to talk that it looks very much like 2007-8, where the market ground out another high into October, which is quite probably how we're set up with the seasonality effect for the pullback followed by presidential years. Presidential years generally are positive. About half, a third to a half of what the first half was. We've had quite a big chart to look at in a minute for the first 158 days of the year. 16% for the S&P, should go up another 6 to 7% from there. But that doesn't rule out, dropping another 5% to then get a 12% rally at the end of the year. So just it's another reason to be careful going forward, but not to throw the baby out with the bathwater. But the fact that the mega bears are allowing for another high, yet again, makes me feel quite happy that we're right with the 345, because they're allowing for it as their base case at the moment, which 2 weeks ago was anything but. I mentioned the Walmart thing. That was it. They're using multiple large language models to create over, that was it, 850,000, not 185, changes to data in the catalog. Without the use of Gen AI, it would have required 100 times the current headcount to complete it in the same amount of time. That is the scale of these cost efficiencies. If that's your company, how much are you going to pay for that? You're going to pay some proper money, aren't you? So there is monetization going on already, left, right, and centre. Ignore all these doomsters on AI. This is a productivity boom coming ahead, which is why we're more likely to be in the mid-90s. It looks more like the start of the internet rather than the internet bubble. We've said before, the sequencing charts from previous melt-ups, the Nifty 50s and the 2000 dot-com crash, we're only about 60% of the way there in terms of the blowout. We haven't had the blowout high yet. And it's not going to be left to the people here. There was an article out last week, I don't know if you saw it, Intel and SoftBank, prior to the Intel meltdown update, we're working on combining the ARM part of SoftBank with some AI and Intel to process the chips so that they could compete with NVIDIA directly, but they fell out and that didn't come through. So, just again, the large players out there aren't just standing back and watching others take all the dough. They want to get involved. So that whole CapEx thing isn't going to go away, which by definition means people second, third tier will be getting bought quite aggressively and receiving funding. So there's an undercurrent of support for tech funds and the tech market. This chart, good. I mentioned distribution of buybacks had come in to support indices. Look, you can see how going into that start of August period, they were back to 50%. Now it's 90%. So all that selling went into very welcome hands at the companies who are pretty price agnostic themselves, which was quite useful that you got price agnostic sellers. So buyers and sellers that didn't really care, hence the level went potty, didn't it? It was quite a ridiculous couple of days. This to me is the whole key of why the market bounced. Within that, the quality traders, advisors, their element of equities went from being super high to almost zero. So you've had a rising market with volatility coming off and a need to get back in. So that is a support for the breakout. Those people that we talked about that trade when volatility is low and dump it straight away, they might hold volatility for years. We've had a 2-year period of falling vol, so they've been putting on trades for 2 years, making multiple upsides, and they've just lost anywhere between 10 and 30% on, depending on what they were dumping. They're net up massively, hence they're price agnostic. They just want exposure off the table, and then as vol comes off, they'll buy back in, which is what's been happening. They may well have top and tail, but it doesn't matter in their model. They want to invest in low vol environment that sequentially moves up or sequentially moves down if they've gone the other way. Conditions have returned back to them to be back fully engaged with the market. I mentioned that earlier. The study, 94% of businesses that use spreadsheets have got critical errors. Well, there's lots of companies out there sorting that out. And when they sort the data out, it's prime for AI processing. I don't know if you've ever tried to do macros yourself over the years, but you always get errors in them, and they've always been useful. We can see just why this whole AI bottom up is working. Takes away a lot of the pain. So remember, August 28th, NVIDIA, it's already up 19% last week. Big zoom back. It looked like there was a bit of a deteriorating chart for NVIDIA. We might look at that in a minute, which I think would be quite useful. I've got a sneaky feeling that they might just turn this whole large cap back into the bull phase when they report. And that you've got people already postulating that the Q3 net number is coming down, blah, blah, blah. We knew they were coming down anyway, but it's kind of confirmation bias coming through from the street about this falling piece of the pie for the Mag 7 because it was always going to come down. An interesting one, if you do trade the FTSE or you want to be playing sterling, etc., to have in the back of your mind is that GDP growth for the first half of the UK and the G7 somehow is at the top. I don't think if you'd have done that blindly, anyone would have got the correct answer. And they're not expected to be at the top at best. They're expected to be in third place by 2025. What Sunak said was true. They should be outperforming the majority of Europe in the short term. We see how bad Italy and Germany have been. Germany particularly. France is a bit of a muddle. It's not real output there. But either way, there's a chance, and it's all back to that nominal we were talking about before. Nominal GDP in the UK has been a similar growth rate to the US, but they've been hit harder by the inflation side of things, the input side, because we import most of the stuff, whereas America doesn't. So then going forward, we get a double whammy if the inflation for goods keeps coming down, the supply side unwinds, and the UK's net real GDP will improve. So hence, there might be a surprise. We might actually be at the top end of that league table, in which case you're going to see a lot more funds flowing through. So my friend Callum Pickering at Peel Hunt mentioned those charts at the weekend, so I was very glad to put those in. S&P 500 returns last week. It was all growth. This consumer discretionary bouncing off the sort of warning numbers through Q2 and massive inflows back into infotech, but everything was positive. So we had a broad-based rally and a tech rally. Thought those things weren't supposed to happen. Remember, the Russell 6000 is the underperformer. It should be at the first half of August. And amazingly, we talked about the seasonality, and quite right. It's Fabo that was big on it. He said if you look at the numbers that Goldman's actually put out, August half one is fifth worst, I think, for the year, whatever it is. But it's normally positive, and so it turns out the S&P sneaked out again for the first 2 weeks of, or the first 16 days of August by Friday night, despite the fact that we had this mega sell-off, in the middle of that. So history's going to not tell you the truth, but in terms of meeting the stats, it's bang on. As I say, it looks like a good week for taking a holiday. Actually, I've looked at that data today. That's interesting. They seem to have pulled it. So China, unless they did it overnight, did they do it overnight? China was supposed to put out their FDI today. What is FDI saying? They didn't do it. So foreign direct investment into China has been falling. Look, this is a really bad chart globally, which is why they're in negative. People are pulling money out of China left, right, and centre. So I want to see what they were saying today. I know maybe this is what I heard a headline saying something about they weren't going to be reporting certain things. Maybe this is one of the things they've pulled. There's another chart back over here. What TS Lombard, Win Smart, Bloomberg were all reporting on this during the week. The scariest China chart out there is the relationship between their money supply and their nominal GDP. Well, look, their money supply has gone negative, which means that nominal GDP should be going down. So remember, it's the real GDP that everyone looks at. That's already flatlining, zero, on bordering on recession. We talked earlier, if nominal falls, that's when your rates are too high. They'd need to get negative rates to compete with that. Have to be super amounts of easing. that gets exported one way. So I've said it for weeks, haven't I? That the biggest problem for the US is potentially deflation, not inflation, that gets exported out of China as they go into meltdown. So we need to be very aware of that going into Q4 and 25. Keep an eye on that data. And remember, they're doing all they can at the moment to stop people buying bonds, which is a self-pick for things going to poo in the economy. People are trying to buy bonds to hide in it, and the government's telling agents not to settle it. They don't want a bond bubble. They know they're going to try and inflate their way out of it. Eventually, people will lose a lot of money on the bonds. They don't want people buying in at the bottom on yields, close to the bottom, because you get this duration thing. The lower the rates go, the prices go asymptotical. They go almost vertical. This is how a lot of bond people made a lot of money in 2008, 2009. We don't really want a repeat of that. When everything goes down, debt gets written off left, right, and centre. So yeah, keep your eye on all that sort of stuff. This week we've got some PMIs. We've got CPI. We've got CPI in the Eurozone and Canada. We've got the Japanese stuff on Friday. So we're supposed to get, maybe they'll bring it out when they do the loan data tomorrow, the FDI. Probably not going to cut rates just yet. But there is another rate coming at some point from China. That's right. I think they've stopped talking about their daily capital flows. So that probably means they're not going to talk about it in totality. So that FDI may have been pulled. FOMC minutes, you mentioned that. Don't fall in love with it. Well, it's the global PMIs. It's not the ISMs. Your jobs and jobs claims. I think it's 1 o'clock. Jackson Hole starts on Thursday. There's hardly anything of real note. Few reasonable names, but nothing mega. Coloplast, medical supplies tomorrow. Plus 500, they actually had a big upgrade today, which is spread betting. You may have had an account, you may not. But they've got massive growth in their client money and their forward customer growth. So they've upgraded their end of year. They've upped their dividend. They're doing a special, doing share buybacks. So ironically, plus 500, a great stock to buy. We've got lows for DIY. Antofagasta copper tomorrow. Toll Brothers for home building, leading indicator kind of stuff. A few department stores this week, TJX and Target. Analog devices, that's data converting semis. We've got Zoom, Snowflake, that is data as a service, so similar to software as a service. All this stuff we're talking about bottom up of processing companies. That should be through the roof. Yeah, not much else really. Any note? Talking heads didn't come across a great deal. Waller potentially starting in a couple of minutes. Today you got Jourdan. He's close to retiring, isn't he? So that might be his last speech. Or maybe save that for the next policy meeting. That might be his last speech. Bostic and Barr. I think they're at the same conference of some sort on Tuesday. FOMC minutes, ECB minutes on Thursday. Jackson Hole starts. Ueda Friday. More Jackson Hole. Bailey speaks at something on Friday night. It's probably Mansion House or something. Be a good dinner by the look at the timing. And again, look out on the weekend next week, Jackson Hole. Chart wise, we're just saying at NASDAQ, we had the channel breakout at the cycle 1 level, which is the 5 primary waves, which is what this channel is. Came out of the channel, came back in, so that looks like it's still valid. And we're looking to top out, hopefully sometime in the next period, but that could include a new all-time high as a subwave. It could be the third wave that tops us out in September as a pullback, and then we put the final topping of this channel in with the end of year rally. But equally, this could all happen in the next few weeks. Either way, I'm leaning towards it being all-time high again in the Nasdaq before we sell off. In the short term, it would look probably something like this. We should be choppy over the next few sessions. To me, it's whether we come before or after Nvidia with this selling off and bouncing, etc., etc. So, like I say, we could wind up to an all-time high. The seasonality could end up being shallow, end of year rally, blah, 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 or this could be the September sell-off itself. Grinding higher until we see otherwise. It's gone. It's already above 61.8 for the pullback. There's not. It could still be just a connector, but it has a better feel for the leading diagonal there, and then we've been grinding out 5 subwaves. So that has to be the base case, I think. Really, it's just how deep this pullback gets for the wave 4. It shouldn't overlap into this wave 1. So 18,800 really is an area we don't want to be going into. That would suggest it is more likely that we've done a connector and ultimately have more downside. So that is a good area to look out for. 18,800 on Nasdaq 100. It's 700 points away, but that is only 4%. Nothing in that respect. S&P, the favourite messy chart, mainly because we've just got the 200-day and the 50-day stocks above 50% moving average. And we're trading at 68% for the 50-day, and we're at 57. But for me, it's more important that we're still holding the overall above 200-day moving average trend. The only concern is it's with summer volume into the rally. You can see that there. You can see that we're in the nodes, which have only really had big volume on sell days. So it is classic for topping out. If we overlaid the MACD, if you've got low volume like that, we'd expect the 5th wave to probably have a lower MACD. So all things to keep an eye on. Nikkei 225 is similar setup to the Nasdaq, really. And it is basically the same trade, isn't it? The whole carry thing. It looks like there's been some carry trade going back on. But 3, 4, 5s, we just need to work out where we're going to grind in the next few weeks. Should be net higher until the seasonality comes in. We've gone through gold. My base case is 5 equals 1. We just need to find out where the 4 finishes. Are we going through a small pullback at the moment, or are we going to hit this 24.50, potentially big support 24.32 to 30? Keep your eye on those two. Only needs one day without any real gold physical demand, and they've been trying to slam it down. If there's anybody with a big short position, there's an incentive to take on gold if you're not going to run into physical for 2 or 3%, and they might try and drive it down. The XY, we talked on Friday how we could roll up to say that was 3 and that was 5, but we've now put in a lower low. I don't think there's enough structure for that to be long enough or high enough to be the wave 2. Wave 2 bounce back. So I think today's low, or ultimately a little bit lower, is where we're going before we get that bounce. So that to me could be the nervousness this week going into Jackson Hole, etc., or it could even be disappointment post Jackson Hole, because there's half a chance that they fudged the info. They've got 3 big datas to come through, and they might just stick with we're data dependent, and we've still got 3 big ones to look at, which is what Gouldsby's hinted at. That might be enough to get an end of week small panic on that they're not even going to cut at all before the data next week and beyond starts to show us that what were we panicking about. UJ, I mentioned this earlier, that is the one that at the moment looks better as 3 swings, which is a connector at the moment, and we're bang on. I'll have to look at where that is. Yeah, we sort of bounced off that up to date. So this level here where we think that the sea leg started potentially. They've taken it out. That's not necessarily the end. It's just a zone where there was a lot of demand. This could come back as a deep retrace, connect and go again. As you said, there is so to me, there's still potential either way. It's don't really want to play at the moment. I want to see more info on which way the dollar's going and what the way they want to say at the end of the week, because we're halfway between two zones. If you can play volatility in any way, straddle or strangle on the options or risk reversals, then yeah, that's a nice way of doing it. But in terms of just playing spot, is it's a flip of a coin really at the moment. And like I said, the dollar might suddenly start strengthening for the end of the week, in which case this becomes connected to the upside, isn't it? At the moment, it's still all up in the air with this because the long-term targets are, 128 or what to be back in the bullish phase, you'd be looking to take out 162. Something dramatic has got to happen either way. Obviously, we're leaning towards this being a low, this potentially being a W of a WX, and then ultimate Y down to 130. But it's all on fundamentals. There's no point particularly guessing UJ at the moment. So if I were you, just play short-term things. That the long-term swing trade is a bit two-way at the moment. Yeah, so back on the weekly preview again, move index, the VIX index, have both come back down into the ranges we wanted. We said we wanted to see the VIX back below 16. Why? If you weren't listening earlier or you weren't here, 16 divided by root 256, which is 16, gets you to 1% volatility. Quant funds and vol control funds want to be down between a half and one. That is the region they're looking for. The volatility has gone out of it. We've had a sequential move up 7 days in a row. So vol's just fallen through the floor. It's been going one way, the index. So a bit of choppiness ahead might just keep us around this level. But you can see where we spent a good proportion of Q2 and into Q3 was around that 12 to 14 level. Why are we bothered about that? Well, once we got to the October 22 bottom, we were well on our way down to much lower levels. We had this big bounce up as the market had quite a choppy end of pattern sell off into October 22, and then once the buying started, take out the consolidation, we've been trending down more or less halfway through the early 21 to late 22 bear market. We've been in that channel. We've been going sideways in that channel since June 23. After that was basically SVB panic, wasn't it? There as that unwound, more or less held that. The October sell-off 23, the April sell-off, but they've always returned to trend right in the middle of this trading channel. I don't think we get that low particularly. I think we go back to sort of 12, 14 for the next few weeks at best. But I reckon anything between 12, 20, the market should still be trending up. Then you just got last week's review, blah, blah, as it happened. A little bit of bottom-up analysis, give you a few clues on what sectors are going to drive the indices in the States and Europe. A few talking heads. Australia, they're still harking on about being vigilant, might have to put inflation rates up still. Across the Australian Sea, Ocean, whatever it is. Wellington again, the opposite way. I said earlier, they're talking about 3% by mid-27 at the latest. Now they think they'll do another 2 cuts by the end of the year if nothing changes. Goolsby, don't think it's a certainty. Harker didn't make any comments. Bostic about Because Goolsby, I mean, it's interesting. They're using him as the calming down man because as of Wednesday, he was already right. It's time we were going. Labour market's gone. Inflation is down, and then he's told to go out and straight bat it. That's why we did the meme today. The fire in the hole at Jackson Hole, and Goolsby's already got the hose out. And then the diary. So I just want to quickly run through that other charts that didn't make it into this week's thingy, just because even bigger than it already is. I talked earlier about hedge funds are going into tech. Look, they're back in their high range. That's according to the Prime book. That's Goldman Sachs. So that's where their holdings are sat, whether they've done it through Goldman's or it gets transferred across. But tech longs from hedge funds are running at a high in the last few weeks. I mentioned people moaning about Mag 7's earnings growth peaking. Well, this was already for the next few quarters. Forward earnings was already falling in these, just may have been tweaked slightly lower than previously, but the trend is still more or less in the same ballpark. Q3, I say a lot of this will change subject to what Nvidia says. They might change the whole total narrative on that. Interesting. The high dividend paying stocks have been outperforming stocks that pay no dividends in the S&P. So that is a kind of hide in the quality names that are paying you. It's almost like a bond proxy kind of thing. But I think a lot of that, as we saw last week, has suddenly unwound and gone back into growth stocks and consumer discretionary growth stocks and infotech. So I think that was into the middle of July. I think you've seen a lot of change as of last week. I don't know whether that data actually included that. May not have done. That probably came out early last week. The thing I've been talking about for weeks about gold, the US is officially at a record 13.4 million barrels a day, and they are now the world's largest oil producer. So all the efforts of OPEC, etc., OPEC plus the US have filled the gap just as demand has been destroyed globally, mainly China. China's been buying oil, but mainly just to stockpile it for activity. So hence, any rallies in oil, we still think they'll probably roll over. Now, I talked about Chinese home prices. They improved relative to consensus for the week, but that still was one of the worst prints they've ever had. Largest fall, even lower than the 2015 crash, down. Second-hand housing down almost 10%, average house price down 8.2. Not good. We've done the scariest chart. I always like, when I see this chart, I always like to save it. Just where do people live? Where are the exposures? What are the going forward? Where are the population biases? We know China and India are the biggest, but it's absolutely huge, isn't it? Yes, with only 340 million, the bigger GDP. That's the interesting one in the next 10 years. Can Nigeria grow their economy? Because they're probably going to be the third biggest population by 2050. Will overtake Pakistan and Indonesia, apparently. Fed's repo is down again below 300 billion. But it has stopped going down. That's the whole point of this thing. So is that the case? Are people being worried, or is it just the fact that everybody wants to hold a relative amount of safe money? I need to keep an eye on that. If that starts bouncing back up, then there might be a few worries to come from the banking side. So just keep an eye on that. This is the interesting one. Like, obviously, a lot through the 2008 crash, lots of people were told to own. Central banks were told to own their own, as big a proportion of their own bonds on the outside, which polarizes risk. I was just thinking when I saw this, the Bank of Japan, they need to put interest rates up. You know, the worry is that people aren't going to buy your bonds. And obviously, they're talking about slowing down their purchases, but they will still be buying bonds. But the main point is it's an illusion of money, isn't it? They're going to be um, spending interest costs themselves. So putting interest rates up is less of a problem than it is um, in reality. I'm just thinking it's obviously going to cause some issues for inter-accounting in its own country, but it's not actual money going out of the country. It's smoke and mirrors within it. So that might just, at the margin, be part of their whole policy. That was all about Norges. It's something that UK should have done when they had the oil dividend in the 70s and 80s. Norges created a sovereign wealth fund, which is now posting $138 billion of first half profit with a lot of exposure to AI stocks. I mean, we're talking about starting from zero with about 10 billion of assets. It's a real missed opportunity over the years. A thing that often gets thrown out around all-time highs is the percentage of stock ownership. Well, it's back at near all-time highs. In the US, 48% of households and non-profit companies owning stock. So that's often cited as a reason why you might start to see more pullbacks, or which in our parlance gets a bit choppier as things top out. You get profit taking. There has been a lot of retail money coming into that August the 5th week. It's one of the highest retail in weeks of the year. So they normally time it wrong. So if they were to sell into the crisis the next few days, lock in the losses, that would explain a lot. God's child, I'm giving you so much free information you don't need to give away. Use it, make profits. That again, that shows this is a sort of fiscal side of things. How much room do a lot of the major countries have to put taxes up any higher? The European ones don't have a lot of room at all. If you go too high, then you lose capital inflows. People start to not. And if you go too low, people don't trust your actual model tax take, so that they tend to see less money going in because they don't trust the viability of the bonds anymore. So it's always been around that sort of 25 to 35 is the sweet spot, and somewhere around 30 has always been really pro area to be. For some reason, Singapore's not in there, but they tend to be a model of having really low tax. We looked at the gold production earlier, and that I think I showed months ago the amount of gold. The amount of gold produced per year is something like a 20th or 25th of the gold demand since start of 23. So that is another reason why it's underpinned. As soon as people start buying gold, you can't produce enough to keep up with it. So it depends on what existing holders want to do with their gold. On the basis people who own gold have got a general idea about what's going on. That's the main reason why it's going up. And now you've got a group of people who were sellers up to 23 central banks, and they're buyers. It's not rocket science why it's doing what it's doing. Another reason why the whole Nasdaq breakout with the large caps in leading edge logic is going to keep going. US Chips Act trends that are coming through based on forecasts. America is going to end up being about 25 to 30% of that market, mainly stealing it from South Korea. And in all sectors, America looks like they're expanding. South Korea obviously better by looking in DRAM as a result. Although from where they are, that's almost just maintaining their share, isn't it? Just an interesting backdrop. So that kind of finishes it for me on those. Quick look at a couple more charts, and then I'll let you crack on. I didn't put in US 10-year. We talked about this breakdown of the week. It signaled within the rotation. But this was all that was getting everybody worried about the recession risk in here. So the yields absolutely plummeted right into the debacle from the carry trade. I think we're probably that put in a significant low, of which we're now in either a consolidation trade to the top of the channel, but we've since crossed it. Look out for if it breaks again down here, then it's probably telling you that the bond market, which has predicted everything properly or the best for the last few months in terms of data, if that breaks through this channel, they're again probably predicting that the data is deteriorating enough for the Fed to be going again. But to me, at the moment, I'm just wanting to see this go and either kiss goodbye to the previous channel again as a kind of consolidation of the first move down, or maybe make this a complete equal legs job, go back into the main channel and then fail again. So a very important channel, I think, at the moment, particularly with the backdrop of rate cuts fading, potentially fading a bit more in terms of size into Jackson and through Jackson before the next data just reaffirms the Fed needs to get on with it. So they've been very good, the bond inflows, at predicting which way the data is going. So keep an eye on that. Geo, what happened to your Instagram? What do you mean by that? I don't know what the official reason was, but yeah, I know we stopped doing little videos for it. Not quite sure what the reasoning is behind that. I'll find out when I come back from holiday, because we're going to have a little chat about strategies and stuff. So I'll let you know as soon as I know. Euro dollar, we talked on Friday about, had that put in the top, or was this an extending third wave? It looks like we've got a higher high, so we'll just move the one to there for now. I do think we are due some form of consolidation in that, which again, if we're expecting the dollar to rise a little bit into Jackson Hole, that should be enough to hopefully get such pullback in. So what would that be? Yeah, so there's potential for us to drop back into this 109 kind of area, I think, really. 109, 108 and a half. That sounds drastic, doesn't it? But yeah, if that is a valid wave one, 108 and a half, 109 looks like a reasonable place to expect pullback. So we just have to see how we react with that DXY strength. Hello, Bletchley. Can I see the UK 100 largest companies migrating to US FTSE companies undervalued? Well, FTSE is undervalued. As we said earlier, we think that there might be a little boon activity-wise. But the government really needs to get on side with the whole incentives for companies listing, etc., in the UK, and the LSE and its owners need to get on board with changing the rules and making it a real investable place again. So some companies, you've seen things like Flutter move across to the US, big growth success stories. You've got to be careful. There's very little tech over here, and if people aren't, I don't know if you're aware, but there's stats showing that UK pension funds have been zero allocated to the UK. So how can you expect anyone else to be paying over here? It's really important to get incentives into people to back UK pension fund investment, and also some infrastructure bond issuance to make people uh, back the UK that way as well. Of which, when surveys are done, I've mentioned it before, people are very happy to get involved in that. End result specific investment. That is the way forward. So yes, the answer to your question is I can see a lot more of it happening unless we pull our finger out. Flutter at the moment, they've stayed as a dual listing. That might be something that there has been a trend towards it of late. There's obviously a trend of tech stocks, not UK tech stocks, just trying to go straight to the US, and some of the biotech companies should never really have lost arm. That was crazy. GU, as we said on Friday, I think we're just hugging the trend for the minute. So the stop loss is the 50-day moving average, 129. Might hit that with the perceived dollar strength. Can we find any reason for UK strength per se from data? There isn't really a lot of data to come. PMIs, maybe we've already had the index of services showing a little bit of slowing down. So I'd like to think the UK PMI for services hits the numbers rather than beats. We'll see. So we've looked at Nikkei and all that sort of stuff. FTSE again still needs a new high to prove that we're still not in a final sell-off mode, but I think we are in the early stages of following the other indices up to that all-time high. So just having a pause type moment, bouncing today. And the FTSE generally, because it's so dollar earnings denominated, doesn't necessarily suffer as much if you've got positive dollar. So still going up, but I think it is likely to be still relatively slower than the US exposure indices. IOGO promo codes, you have to go to the code pages on Discord. I think we had a 30% on last week, but I'm not sure whether that finished at the weekend. Let me have a look. Alpha Swing, which was Swingers, wasn't it? That was 30% off. How long was that on for? So try that one. Try Swingers. Prior to that, what was it? I don't know. You have to go in public chat and ask. I'm sure someone will remember. Does anyone remember what we were before that? Normally 20%. I don't know what the actual code is. But that is it for me, really. Obviously, I'm going away on Wednesday for 2 weeks, so there won't be any live shows until the first week of September. I'll probably do one on Wednesday as a catch up, but I need you guys to tell me what's going on. So I'll probably be trying to shut off for 2 weeks. Thank you, Bletchley. I have received the preview. When this is finished, I'll try and send it out so you can double up on those charts, etc. But thanks for your questions today and attending. Been brilliant. Like I say, once we get back in September, I'll try and get some giveaway codes for the lives. See how that helps with the ones that are looking for them. Good luck with your trading. Remember, be careful for the next couple of weeks and into September, because it is seasonally a dangerous period. But we should have all things as we hope for. We should still get an all-time high before September, I think. So good luck with your trading. Keep your eye on Jackson Hole, DNC, and Mr. Uoda. Over and out from me.